So today I'm gonna be talking about the business fundamentals. I'm gonna start with the introduction and then I'm gonna talk about the basic forms of business ownership. Then I'm gonna go to the relationship of revenue, expenses, and profit. That was my favorite part of this project. And then I'm gonna follow to the functions of management and I'm gonna wrap it all up in the end. So in this presentation, I will dive in the fundamentals of business. I will go through the various ways business are owned, the flow of money through revenue, expenses, and profit, and the crucial tasks involved in managing a business. I'm gonna start talking about the sole proprietorship, the basic forms of business ownership. There are more than three, but today I'm gonna be talking about the basic ones, the three basic ones. So, sole proprietorship is owned and operated by a single person. It's easier and inexpensive to start with minimal formalities. It's not as hard to start as like partnerships or corporations, and the owner makes all the decisions without sharing the authority. I'm gonna talk about the advantages and disadvantages. So, the advantages. As a sole owner, you have complete control over decision making and the direction of the business. This autonomy allows for quick and decisive actions. The sole proprietorships are straightforward to establish and operate. There are few legal formalities and paperwork compared to other business. And the income from the business is typically reported on the owner personal tax return. So it's really good to have a sole proprietorship. So now I'm gonna talk about the disadvantages. Sole proprietors often face challenges in raising substantial capital for their business. Since the business is tied to the personal finances of the owner, the available resources may be limited. In the event of business debts, lawsuits, or other financial obligations, the owner's personal assets are at risk. And as a sole proprietor, the responsibility for all aspects of the business fall on the owner's lap. This includes operation, marketing, finance, and a lot more. Now I'm gonna talk about the partnership. The partnership has multiple owners, they share their responsibility, and they have to sign a legal agreement which will decide um, who takes the money, who will be with the company in case if something happens, if someone dies, how is it gonna work, what are the responsibilities of everyone involved in the team, in the partnership. So yeah, I'm gonna talk about the advantages and disadvantages now. The advantages of a partnership is that they allow for the distribution of tasks and responsibilities among the partners. This shared workload can lead to increased efficiency and productivity, as each partner focuses on their strengths and areas of expertise. Also, the partnerships often involve individuals with different skills, knowledge, and experiences. This diversity can contribute to well-rounded decision-making, innovation, and how they adapt, as partners bring varied perspective to the business. Profit and losses are typically passed through the individual partners who report them on the personal income tax returns. This avoids the double taxation associated with some other business structures. The disadvantages. While partnerships provide the advantage of shared resources and responsibilities, profits are also shared among the partners based on the agreed upon terms. This comes back to the legal agreement. So they decide how much each part is gonna get. This distribution may be perceived as a drawback by people who prefer to retain full control and sole ownerships. Also, the differences in opinions, goals, or work styles among the partners can lead to conflicts. And finally, in a general partnership, each partner has unlimited personal liability for the business debts and obligations. This means personal assets are at risk in the event of financial difficulties or legal issues, highlighting a potential downside to the structure. Now, moving on to corporations. A corporation is a legal entity that is separated and distinct from its owners, known as shareholders. It is created through a legal process and operated as an independent entity with its own rights and obligations. It's almost a person. Corporations are formed to engage in business activities and they can exist with no time. For example, the changes of ownership doesn't matter if someone dies, they are gonna still exist is independently. And there are two types of corporations. There is the C corporation and the S corporation. The C corporation is when the profits are taxed at both corporate and individual levels. There are no restrictions on the number of shareholders and they can issue multiple classes of stock. On the other hand, the S corporation has to pass through taxation and it avoids double taxation. And it is limited to 100 shareholders and they can only use one class of stock. Only one class is allowed. So I'm gonna talk about some advantages and disadvantages of it now. First, beginning with the advantages, the shareholders' personal assets are protected from business debts and liability. The liability is generally limited to the amount invested in a company, and that is really good. Corporations can raise funds by issuing stocks and bonds, allowing them to attract a large pool of investors. And finally, the corporation have perpetual existence, meaning the business can continue to operate despite changes in ownership or in the death of shareholders. Now moving on to the disadvantages of corporations. The corporations often have complex organizational structure involving various levels of management, shareholders, and boards of directors. The C corporations are subject to double taxation, where the corporation is taxed on its profits and shareholders are taxed on dividends received. The corporations are subject to extensive regulatory requirements and compliance standards, leading to higher administrative and legal costs. Now moving forward to the relationship of revenue, expenses, and profit is a financial dynamic. The income, spending, and profit, my favorite part. So, revenue is the total income generated by a business through its primary operations, such as sales of goods or services. The expenses are the costs incurred by a business in its day-to-day operations to generate revenue. These costs include both direct and indirect expenditures. So, revenue is the inflow. It represents the money coming into the business from its customers or clients. Revenue can come from a lot of sources like sales, services, fees, licensing, subscription, and a lot more. Expenses are the outflow. Expenses represent the money flowing out of the business to pay for things like rent, utilities, employee salaries, raw materials, marketing, and other operational costs. And the profit, the bottom line. Why is it called bottom line? Because it appears at the bottom of the income statement, summarizing the financial performance of the business. And the profit is a key indicator of a company's financial health and success. Positive profit indicates that the business is generating more revenue than is spending on expenses. And the profit equals revenue minus the cost. Now moving forward to the functions of management. Starting with planning. Planning involves setting objectives, identifying resources, and determining the actions and strategies needed to achieve an organizational goals. There are some key activities, and I'm gonna talk about two. The first one is defining goals and objectives, and the second one is developing plans and strategies, which is really important to start with. After, we move on to organizing. Organizing is the process of arranging resources and tasks to achieve the organizational objectives. It involves creating a structure, defining roles and responsibilities, and establishing relationships between individuals and departments. The key activities for organizing is designing organizational structure and defining roles and responsibility. Now, moving to leading. Leading involves influencing and guiding individuals or teams to work towards the achievement of organizational goals. It includes motivating, communicating, and resolving conflicts. The key activities that I found here was motivating and inspiring the employees, communicating the vision and goals. Now, finally, I'm gonna talk about the controlling. Controlling involves monitoring performance, comparing it with established goals, and taking corrective action as necessary. It ensures that the organization is on track to achieve its objectives. And the two key activities on controlling are monitoring and measuring performances, and also comparing actual results with the planned goals. It's important to remember that effective management requires a great integration of planning, organizing, leading, and the controlling functions. So, in conclusion, we've studied crucial aspects of business, from understanding different ownership structures to the dynamics of revenue, expenses, and profit. Additionally, we explored the essential functions of management that play a crucial role in pushing a business towards its goals. By understanding these fundamentals, people can navigate the business world with a more clear perspective and making informed decisions for success.